Legal disclaimer. The content presented in this video series is strictly for educational, informational, and entertainment purposes only. It does not constitute financial, investment, tax, or legal advice. Foreign exchange trading, commonly known as Forex, carries a high level of risk and may not be suitable for all investors. The high degree of leverage available in Forex trading can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. There is a possibility that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. Past performance of any trading system or methodology is not necessarily indicative of future results. Viewers are strongly advised to conduct their own due diligence and consult with a certified professional financial advisor before making any investment decisions. You assume full responsibility for any trades you make and any consequences resulting from them. Imagine standing on the shore of a small lake. That lake represents the New York Stock Exchange, the largest stock market in the world, moving roughly $25 billion in volume every single day. It is massive, intimidating, and powerful. Now imagine turning around and facing the Pacific Ocean. That is the foreign exchange market. While the stock market moves billions, the Forex market moves over $7.5 trillion every single day. It is the largest, most liquid, and most ruthless financial market in human history. It is a market that never sleeps, operating 24 hours a day, 5 days a week, spanning from Sydney to Tokyo, London to New York. But here is the statistic that nobody wants to tell you. The statistic that the flashy lifestyle marketers on social media work very hard to hide. Nearly 90% of retail traders lose 90% of their capital within their first 90 days. This is known in the industry as the 90-90-90 rule. The odds are statistically stacked against you because you are not just trading against other individuals. You are stepping into an arena dominated by central banks, hedge funds, and high-frequency trading algorithms designed by mathematics PhDs to extract liquidity from uninformed participants. If you enter this market without a map, you are not an investor. You are prey. You have likely clicked on this video because you are tired of the noise. You have seen the promise of financial freedom, the allure of working from a laptop anywhere in the world, and the potential to compound wealth independent of a traditional 9-to-5 job. But you have also likely encountered a wall of conflicting information, expensive courses that deliver nothing, and indicators that only work in hindsight. The problem facing most beginners today is not a lack of information. It is an overload of low-quality, fragmented information that lacks context. Most guides give you a few chart patterns and tell you to go risk your hard-earned savings. That is not what we are going to do here. This is part 1 of a comprehensive 10-part deep dive masterclass. Over the course of this series, we are going to deconstruct the Forex market from the ground up. We are not here to sell you a signal service or a magic robot. We are here to build your professional foundation. We will bridge the gap between the institutional reality of the market and the retail trader's perspective. By the end of this series, you will understand not just how to read a chart, but how to think like a risk manager, how to interpret macroeconomic data, and how to execute trades with the precision of a sniper rather than the recklessness of a gambler. We are going to take you from total novice to a competent, informed market participant who understands exactly why price moves, who moves it, and how to position yourself to potentially capture a piece of that $7 trillion daily flow. To understand Forex, you must first strip away the illusion that it is simply a graph on a screen going up or down. That chart is merely a visual representation of global value. When you buy a stock, you are buying a share of a specific company. When you trade Forex, you are buying the economy of one nation and selling the economy of another. It is a geopolitical struggle expressed in numbers. If you buy the Great British Pound against the US dollar, you are essentially betting that the economic outlook of the United Kingdom is currently stronger, or will become stronger relative to the United States. This involves interest rates, inflation data, employment numbers, political stability, and trade balances. The Forex market is the central nervous system of the global economy. It dictates the price of the gas you put in your car, the cost of the phone in your hand, and the value of the savings in your bank account. However, before we ever look at a candlestick chart or discuss technical analysis, we must address the concept of the zero-sum game. In the futures and Forex markets, for every winner there is a loser. This is not like the stock market where the overall market capitalization can grow, allowing everyone to theoretically make money during a bull run. In currency trading, value is relative. If you make $1,000 profit on a trade, That money did not appear out of thin air. It came from someone else's account who took the opposite side of that trade. It might be a Japanese exporter hedging their payroll, a European bank balancing their books, or another retail trader in a basement in Chicago who made the wrong call. This reality is crucial to internalize because it defines the competitive nature of the business. You are not trying to beat the market, you are trying to be smarter than the counterparty. The reason the failure rate is so high is that most beginners treat Forex as a casino rather than a business. They look for the thrill of the bet. They over-leverage their accounts, meaning they borrow heavily from their broker to control large positions with a small amount of money. While leverage is a powerful tool that can magnify returns, it is a double-edged sword that magnifies losses just as fast. A 1% move in the market, which is a common daily occurrence, can wipe out an entire account if it is leveraged 100 to 1. This is why the 90-90-90 rule exists. It is not because the market is rigged, although it is heavily manipulated by volume. It is because retail traders often lack risk management protocols. They risk 5%, 10%, or even 50% of their account on a single trade idea because they are chasing a dopamine hit, not a statistical edge. We are going to define edge. In trading, an edge is simply a statistical advantage that plays out over a large sample size of trades. It is the same business model used by casinos. The casino does not know if it will win the next hand of blackjack. Does not care. It knows that over 10,000 hands, the mathematical probability guarantees it will end up profitable. As a trader, your job is to become the casino. You need to stop trying to predict the future, which is impossible, and start managing probabilities. This shift in mindset from prediction to probability is the single hardest hurdle for a beginner to overcome. Human beings are wired to want certainty. We want to know for sure that if we buy now, the price will go up. The market does not offer certainty. It offers ambiguity. Learning to function and thrive within that ambiguity is the skill we are going to develop. Furthermore, we must acknowledge the participants in this arena. The top tier consists of the interbank market. This is a network of the world's largest banks: Citi, JP Morgan, Deutsche Bank, UBS, and others. They transact directly with each other and facilitate the massive volume required for international commerce. Below them are the hedge funds and commercial companies like Apple or Toyota, who trade currencies to conduct business in different countries. Then, at the very bottom of the food chain is the retail trader. That is us. We are the small fish swimming among sharks. The institutional players have access to information faster than we do. They have deeper pockets and can move the market with their orders. We cannot move the market. We can only surf the waves that they create. This means our strategy must be based on identifying where the smart money is going and hitching a ride on their momentum, rather than trying to stand in front of a freight train. In this series, we will dissect the 3 pillars of successful trading: technical analysis, fundamental analysis, and psychological analysis. Technical analysis involves reading the charts, identifying patterns, and understanding market structure. Fundamental analysis involves reading the economic health of nations, understanding interest rate cycles, and following geopolitical events. Psychological analysis, arguably the most important, involves mastering your own emotions: fear, greed, hope, and regret. You can have the best technical strategy in the world, but if you panic when a trade goes slightly against you, or if you get greedy and refuse to take profit, you will fail. We are embarking on a journey that requires patience. It requires you to unlearn bad habits and adopt a professional discipline. Do not expect to master this in a week. This is a profession that takes years to perfect, similar to engineering or medicine. But if you stick with this 10-part masterclass, if you take notes, if you study the examples we provide, and if you respect the risk involved, you will be miles ahead of the average beginner. You will be equipped with the knowledge to protect your capital first and grow it second. In the next part of this series, we are going to dive directly into the mechanics of the market. We will explain exactly what a currency pair is, how to read a quote, what a pip is, and how to calculate profit and loss so you know exactly what is at stake before you ever place a trade. We will demystify the jargon and give you the vocabulary of a professional trader. But for now, understand the gravity of the arena you are entering. Respect the risk. Prepare your mind. Welcome to the world of foreign exchange. Let's begin. To understand the mechanics of the Forex market, you have to fundamentally alter the way you think about buying. When you go to the grocery store and buy an apple, you exchange money for a physical good. You give the cashier $1, they give you the fruit. The transaction is linear. In Forex, however, you are not buying a good. You are simultaneously buying one currency and selling another. It is a two-way transaction, a barter system modernized for the digital age. Every single trade you will ever take involves a currency pair. Imagine you are an American tourist arriving in Paris. You walk up to the exchange booth with $500 in your hand. You want euros. To get those euros, you have to sell your dollars. You are effectively long on the euro and short on the dollar for that brief moment. Let's break down the anatomy of a currency pair, using the most traded asset in the world as our primary case study, the euro to US dollar. In this pair, the first currency listed, the euro, is known as the base currency. The second currency, the US dollar, is the quote currency. This order never changes. The base currency is the commodity you are trading, and the quote currency is the money you use to pay for it. If the price of euro to US dollar is trading at 1.1000, it simply means that 1 euro, the base, is worth $1.10, the quote. This relationship acts like a seesaw. If you click buy on your trading platform, you are buying the base currency, euro, and selling the quote currency, dollar. You make a profit if the euro gains strength against the dollar, or if the dollar becomes weaker against the euro. Conversely, if you click sell, you are selling the euro and buying the dollar, anticipating that the euro will fall in value relative to the greenback. This is why Forex is recession-proof in terms of opportunity. Even if the US economy is crashing and the dollar is plummeting, you can make money by selling the dollar against a stronger currency like the Swiss franc or Japanese yen. There are three distinct categories of pairs you need to recognize, and your choice of which to trade will dictate your risk profile. First, we have the majors. These are the heavyweights. They always include the US dollar paired with another major economic power. Euro to US dollar, pound sterling to US dollar, US dollar to Japanese yen, US dollar to Swiss franc, Australian dollar to US dollar to Canadian dollar, and NZD/USD. These pairs account for roughly 80% of all daily trading volume. Because the volume is so massive, these pairs are the most liquid and usually the cheapest to trade. Second, we have the minors, often called crosses. These are pairs that include major currencies but do not include the US dollar, such as euro to pound sterling to Japanese yen, or euro to Australian dollar. These can be slightly more volatile and often have slightly higher transaction costs. Finally, we have the exotics. This is where you pair a major currency with the currency of a developing or emerging economy, like the US dollar against the Mexican peso, US dollar to Mexican peso, the South African rand, USD/CAR, or the Turkish lira, USD/TRY. Trading exotics is like navigating a jungle. The moves can be massive and wild due to lower liquidity and political instability in emerging markets. For a beginner, the majors are the safest training ground. Now let's talk about how we measure movement. In the stock market, you might say a stock went up by 50 cents. In Forex, we use a unit of measurement called a pip, which stands for percentage in point, or price interest point. For most currency pairs, a pip is the fourth decimal place. If the euro to US dollar moves from 1.1050 to 1.1051, that is a 1 pip movement. If it moves from 1.1050 to 1.1060, that is a 10 pip movement. There is one major exception you must memorize. Any pair involving the Japanese yen, JPY. In JPY pairs, the pip is the second decimal place. So, if US dollar to Japanese yen moves from 110.50 to 110.51, that is 1 pip. Why do we obsess over the fourth decimal place? Because in Forex we are trading vast amounts of leverage. A tiny fraction of a cent movement, when leveraged properly, can equate to hundreds or thousands of dollars in profit or loss. This leads us to the concept of lots. You do not trade shares of currency, you trade lots. A standard lot represents 100,000 units of the base currency. If you buy one standard lot of euro to US dollar, you are effectively controlling 100,000 euros. A mini lot is 10,000 units, and a micro lot is 1,000 units. Here is the math that separates the professionals from the gamblers. If you are trading a standard lot, every single pip movement is worth roughly $10. If the market moves 100 pips, which is a reasonable weekly range, you either made or lost $1,000. If you are trading a mini lot, each pip is worth $1. If you are trading a micro lot, each pip is worth 10 cents. Most beginners open a brokerage account with $500 and immediately try to trade standard lots. This is financial suicide. If you trade a standard lot with a small account, A mere 20-pip move against you could trigger a margin call, where the broker forcibly closes your trade to protect their capital, wiping you out instantly. We must also address the bid and the ask. Every time you look at a quote, you will see two prices. The bid is the price at which the broker is willing to buy the base currency from you. The ask is the price at which the broker is willing to sell the base currency to you. The ask price is always higher than the bid price. The difference between these two numbers is called the spread. Think of the spread as the fee you pay to enter the nightclub. It is how no commission brokers make their money. If the spread is 2 pips, you are instantly down 2 pips the moment you open a trade. You need the market to move 2 pips in your favor just to break even. This is why trading exotic pairs is dangerous for beginners. The spread on the US dollar against the Mexican peso might be 50 or 100 pips, meaning you are in a deep hole the second you click the button. The majors, having the highest volume, offer the tightest spreads, sometimes as low as 0.1 pips on institutional accounts. Let's construct a imagine if scenario to solidify this. Imagine you analyze the British pound against the US dollar, pound sterling to US dollar. You believe the pound is undervalued. You decide to buy. The current price is 1.3000. You have a $5,000 account. You decide to exercise proper risk management, which we will detail later, and trade one mini lot, 10,000 units. This means each pip is worth $1. You enter the trade. You immediately see minus $2.00 in your profit/loss column. That is the spread. The market fluctuates for 3 hours. Eventually, news breaks in London, and the pound surges. The price moves from 1.3000 to 1.3050. That is a 50 pip increase. Since you are trading one mini lot, $1 per pip, you have made a gross profit of $50. Now change the variables. Imagine the exact same scenario, but you got greedy. You used massive leverage to open 5 standard lots because you wanted to get rich quick. 5 standard lots means you are trading $50 per pip. If the market moves that same 50 pips in your favor, you make $2,500. Sounds amazing, right? But what if the market moved 50 pips against you? You would lose $2,500, half of your entire $5,000 account, in a single afternoon. This happens every single day to thousands of people. They confuse leverage with genius. Understanding the math of pips, lots, and leverage is the mechanical skeleton of trading. Without it, you are paralyzed. But having the skeleton isn't enough. You need to know when to use it. The Forex market is open 24 hours a day, but it is not active 24 hours a day. There are specific windows of time where the volatility explodes and the real money is made, and there are dead zones where the market barely moves, and the spreads widen to eat up your capital. Imagine trying to surf in a lake versus the ocean. You can have the best surfboard strategy and the best balance psychology, but if there are no waves volatility, you aren't going anywhere. You need to know when the tide comes in. You need to know about the kill zones. In the next part of this masterclass, we are going to break down the 3 major trading sessions: Tokyo, London, and New York. We will reveal why the overlap between 2 specific sessions creates a chaotic window of opportunity that professional day traders wait for every single morning, and how you can synchronize your life to trade the most profitable 2 hours of the day. Time is the currency you cannot deposit. In the world of Forex, timing is not just a variable. It is the terrain itself. You could have the most perfect technical setup, a pattern that has played out historically 1,000 times, but if you execute that trade when the major banks are closed and the liquidity providers are offline, you will likely watch your trade stagnate for hours, slowly bleeding capital through swap fees, or worse, getting stopped out by a random spike caused by low volume. To treat the 24-hour market as a continuous stream of equal opportunity is a rookie mistake. The market breathes. It has a pulse. It inhales liquidity and exhales volatility. You need to learn to sync your breathing with the market's rhythm. We divide the trading day into 3 major sessions, effectively chasing the sun around the planet. It begins with the Asian session, often referred to as the Tokyo session. This kicks off around 7 p.m. Eastern Standard Time. While Tokyo is the financial hub, this session also encompasses Sydney, Singapore, and Hong Kong. Historically, the Asian session is characterized by consolidation. The massive institutional volume from Europe and America is offline. The volatility is generally lower. This does not mean the market stops. It means it behaves differently. Imagine you are looking at a chart of the euro to US dollar during the Asian session. You will often see the price bouncing between a tight upper level and a tight lower level, creating a narrow channel. This is known as the Asian range. For aggressive day traders looking for massive 100-pip home runs, this session can be frustrating. However, for sophisticated algorithms and range trading strategies, this is a hunting ground. The primary participants here are Japanese exporters converting their earnings and central banks managing reserves. The pairs that see the most legitimate movement during this time are, unsurprisingly, those involving the Japanese yen (JPY), the Australian dollar (AUD), and the New Zealand dollar (NZD). If you are a night owl in the US living on the West Coast, this might be your window, but you must temper your expectations regarding the size of the moves. Then the giant wakes up. At approximately 3 a.m. Eastern Standard Time, the London session begins. London is the historical financial capital of the world for Forex. It is the heart of the interbank market. Roughly 30 to 40% of all daily Forex volume is transacted during this session. When London opens, the Asian range is often shattered. We see what is called an injection of liquidity. Trends that will define the entire day often begin right here. Case studies of market structure often show a phenomenon known as the London breakout. Imagine the price was stuck in a 20-pip box all night during the Asian session. As the London dealing desks come online, orders flood the market. The price violently breaks out of that box. Many beginners see this breakout and immediately chase it, buying as the price shoots up. But here is where the smart money operates. Often that initial burst is a fake-out, a maneuver to trap retail traders into a position before reversing the price aggressively in the true intended direction. Understanding the temperament of the London session, its propensity for volatility and false moves, is vital for survival. This is not a gentle market. It is a volatile beast involving the Great British Pound (GBP), the Euro, and the Swiss franc (CHF). As the London session matures, we approach the most critical window of the day, the New York session open. This occurs at 8 a.m. Eastern Standard Time. The United States dollar is involved in nearly 90% of all currency transactions. When New York opens, the engine of the world's largest economy starts revving. This is when crucial economic data is released. Reports like the non-farm payroll (NFP), Consumer Price Index (CPI), and GDP data are typically released at 8:30 a.m. Eastern Standard Time. These reports act as catalyst bombs, capable of sending a currency pair moving 50 to 100 pips in a matter of seconds. But the true magic, the golden hour for traders, occurs during the London-New York overlap. This takes place roughly between 8 a.m. and 12 p.m. Eastern Standard Time. For these 4 hours, the world's two largest financial centers are open simultaneously. The London bankers are finishing their day, looking to close out positions or hedge their books, while the New York bankers are just arriving, sipping their coffee, and looking to enter the market. This collision creates the highest liquidity and volatility of the entire 24-hour cycle. Imagine you are a surfer. The Asian session is like a calm lake, ripples but no ride. The London session is unpredictable, choppy waves. The overlap? The overlap is a consistent, powerful tidal swell. This is why many professional day traders in the US only work from 8 a.m. to 11 a.m. They capture the bulk of the day's movement in 3 hours and then walk away. This is the kill zone. If you value your time and want to maximize efficiency, studying price action during the overlap is non-negotiable. Conversely, attempting to trade immediately after the London market closes, around 12 p.m. Eastern Standard Time, often leads to the doldrums. Volume dries up. Trends stall. The price starts to drift aimlessly. Beginners often give back all their morning profits during this low-volume afternoon session because they don't know when to stop. Let's analyze a hypothetical scenario to illustrate the cost of bad timing. Trader A and Trader B both identify a valid setup to buy the pound sterling to US dollar. They both have the same entry price and stop loss. Trader A executes the trade at 9:30 a.m. Eastern Standard Time, right in the heat of the overlap. Because volume is high, the spread is tight, maybe 0.8 pips. The influx of buying pressure pushes the price up quickly, hitting their profit target in 45 minutes. Trader A makes 2% and goes to lunch. Trader B, working a day job, gets home and sees the same setup at 6 p.m. Eastern Standard Time. This is the dead zone between the New York close and Tokyo open. Trader B enters the trade. First, the spread has widened to 3.0 pips because liquidity is low. Immediately, Trader B is in a deeper hole. Because there is no volume, the price doesn't move. It wiggles, chops. For 4 hours, Trader B stares at the screen stressed, as the trade hovers around break-even. Then a minor erratic tick, caused by a single large order in a thin market, spikes the price down just enough to hit the stop loss before drifting back up. Trader A and Trader B took the same trade. Trader A won because of when they traded. Trader B lost because they ignored the session dynamics. Furthermore, understanding sessions helps you choose your currency pairs intelligently. If you are forced to trade during the Asian session due to your work schedule, it makes little sense to trade the pound sterling to US dollar or euro to US dollar, which are largely dormant. You should be looking at the Australian dollar to Japanese yen or NZD/JPY. You must adapt your asset selection to the time of day. You are matching the instrument to the environment. This concept of liquidity is not just about volume, it is about the ease of execution. In high liquidity environments, the overlap, you can enter and exit large positions without slippage. Slippage occurs when you try to buy at 1.5000, but because the market is moving so fast or there are no sellers at that price, your order gets filled at 1.5005. You just paid a penalty for entering a thin market. During the overlap, order books are thick, meaning your technical analysis is more likely to be respected by the market mechanics. So you now understand that arena, Forex, the rules, pips, lots, leverage, and the schedule, sessions. You know where to look and when to look, but you still do not know what you are looking at. When you open your trading platform, you are greeted by a series of red and green rectangles marching across the screen. To the untrained eye, it looks like random noise. To the professional, it is a sophisticated language telling a story of war between buyers and sellers. These rectangles are called Japanese candlesticks. They are the primary tool we use to interpret price action. They date back to 18th century Japanese rice merchants who developed a method to track not just the price of rice, but the emotion of the traders dealing in it. A single candlestick can tell you if the market is confident, terrified, indecisive, or exhausted. If you cannot read this language, you are illiterate in the financial markets. In the next part of this masterclass, we are going to dissect the anatomy of a candlestick. We will move beyond simple lines and teach you to read the wicks and bodies that reveal exactly where the smart money is hiding their orders, and how to spot a reversal before it even happens. If you look at a standard line chart, you are seeing a one-dimensional representation of reality. A line chart typically only connects the closing prices of a time frame, tells you where the market ended, but it hides the journey of how it got there. It is like reading the final score of a football game without knowing if it was a blowout or a nail-biting comeback in overtime. To trade professionally, you need the full story. You need to see the panic, the greed, the rejection, and the conviction. This is why we use Japanese candlesticks. A single candlestick is a data visualization tool that displays 4 specific price points for a given time period: the open, the high, the low, and the close. If you are looking at a 1-hour chart, each candle represents 60 minutes of trading data. The thick, colored part of the candle is called the body. The thin lines extending from the top and bottom are called the wicks, or shadows. Mastering the relationship between the body and the wick is how you begin to read the market psychology. Let's dissect the anatomy of a bullish candle. Usually colored green or white, this candle tells us that the price closed higher than it opened. The bottom of the body represents the opening price, the moment that hour began. The top of the body represents the closing price, the moment that hour ended. The bottom tip of the lower wick shows the lowest price reached during that hour, and the top tip of the upper wick shows the highest price. Now imagine the story this tells. Suppose you see a large green body with very small wicks. This indicates that buyers were in total control. The market opened, buyers stepped in, they pushed the price up, and they held it there until the close. There was very little resistance from sellers. This signals strong momentum. Conversely, let's look at the bearish candle, usually red or black. Here the price closed lower than it opened. The top of the body is the open and the bottom is the close. If you see a massive red body, it means sellers dominated the session, crushing the price down with heavy volume. But the real secrets, the clues that the smart money leaves behind, are usually found in the wicks. The wicks represent failure. They represent rejection. Let's create a scenario to illustrate this. Imagine you are watching the pound sterling to US dollar pair. The candle opens and immediately starts pushing up. The green body grows taller and taller. It looks like a massive breakout is happening. Retail traders, seeing this green momentum, start clicking buy in a frenzy, fearing they will miss out. But then halfway through the hour, the momentum stalls. A massive institutional sell order hits the market. The price is pushed back down. It drops all the way back down, erasing all those gains, and closes near the very bottom. What is left on the chart? A small body at the bottom and a very long upper wick. This specific shape is often called a shooting star or a pin bar. What does that long upper wick tell you? Tells you that buyers tried to push the price higher, but they failed. They were overwhelmed by sellers at that higher price point. The market rejected the higher price. All those traders who bought at the top of that wick are now trapped in losing positions. This is a powerful bearish signal. It suggests that the momentum has shifted from up to down, and a reversal might be imminent. Historical trends suggest that the longer the wick relative to the body, the stronger the rejection. If you see a long wick sticking out the bottom of a candle, it means sellers tried to push the price down, but buyers stormed in and pushed it back up. This is a bullish rejection, often called a hammer. It signifies that the market found a price floor that it refused to break. However, a single candle does not make a strategy. Context is everything. A hammer candle that forms in the middle of a sideways range is often just noise. But a hammer candle that forms after a 3-week decline? That is a potential gold mine. That is the market screaming, "We are done going down." Let's examine another critical pattern. The engulfing candle. This is a 2-candle formation that signals a massive shift in power. Imagine a small green candle, representing a quiet hour of buying. The very next hour, a massive red candle forms. This red candle opens above the previous close and closes below the previous open. The body of the red candle completely engulfs, or covers the body of the green candle. This is a violent takeover. It tells you that in the second hour, the sellers completely wiped out the progress of the buyers and then some. Historically, engulfing patterns at the top of a trend are strong indicators that the trend is ending. It is the visual representation of the bears wresting the steering wheel away from the bulls. Then there is the doji. This is a candle where the open and close prices are virtually identical. It looks like a cross or a plus sign. It has almost no body, just wicks. The doji represents indecision. It is a stalemate. The buyers pushed up, the sellers pushed down, but nobody won. When you see a doji after a long strong trend, pay attention. It means the trend is running out of steam. The conviction is gone. It is often the calm before the storm, signaling a potential reversal or a breakout in the opposite direction. You must stop looking at these patterns as geometric shapes to be memorized, and start viewing them as psychological footprints. Every time you see a wick, ask yourself, who failed here? If the wick is on top, buyers failed. If the wick is on the bottom, sellers failed. Trading is largely about identifying where other participants are trapped and betting against them. Consider the railroad tracks or tweezer tops. This occurs when 2 consecutive candles have the same high point. The first candle pushes up to a price, say 1.5000, and closes. The next candle tries to break 1.5000 again but fails and drops. This double failure at the exact same price level indicates a strong wall of sell orders. Institutions are defending that level. It is a clear sign that the ceiling is solid, and the path of least resistance is likely down. It is crucial to note that different time frames tell different stories. A shooting star reversal candle on a 5-minute chart might just result in a small 10-pip pullback. A shooting star on a weekly chart might signal a market crash that lasts for 6 months. As a beginner, you should focus on higher time frames, the 4-hour and the daily charts. These time frames filter out the noise of the lower time frames. A signal on the daily chart carries significantly more weight and reliability than a signal on the 1-minute chart, because it represents a much larger sample size of data and volume. However, identifying a candle pattern is only step 1. If you blindly sold every time you saw a shooting star, you would likely drain your account. Why? Because a signal without a location is meaningless. Imagine seeing a stop sign. If that sign is at a busy intersection, it is critical. If that sign is lying in a ditch on the side of a cornfield, it is irrelevant. Candlesticks are the sign. Market structure is the intersection. You need to know where on the chart these candles are forming. Is the hammer forming at a historic low? Is the shooting star forming at a price that hasn't been broken in 5 years? To answer these questions, we need to map the battlefield. We need to draw the lines that define the playing field. We need to understand support and resistance. In the next part of this masterclass, we are going to teach you how to draw these zones like a professional. We will move away from the single candle and look at the bigger picture, the waves, the trends, and the levels that act as invisible floors and ceilings for price. We will show you how to combine the what, the candlestick, with the where, the support zone. to create a high-probability trade setup that puts the odds mathematically in your favor. This is where the strategy begins to come together. Price memory is the invisible force that governs every chart you will ever look at. Markets do not move randomly. They move based on the collective memory of millions of participants. If the price of gold stopped falling at exactly $1,900 3 times in the last month, the entire world is watching that $1,900 level. They remember it. They respect it. This phenomenon creates what we call support and resistance. If candlesticks are the language of the market, support and resistance are the grammar that gives that language structure. Without it, you just have a jumble of words making no sense. Imagine you are in a multi-story building. You are standing on the floor. That floor is support. It prevents you from falling to the basement. You throw a ball up and it hits the ceiling. That ceiling is resistance. Prevents the ball from flying into the sky. In the Forex market, support is a price level where buying pressure is strong enough to overcome selling pressure. It is a zone where the price has historically struggled to drop below. Resistance is the opposite. It is a price level where selling pressure is strong enough to overcome buying pressure, preventing the price from rising further. Most beginners make a critical error here. They treat these levels as thin, precise lines. They draw a single line at 1.0500 and think that if the price hits 1.0501, the level is broken. This is wrong. You must view the market in terms of zones, not lines. The market is messy. It is organic. Think of support not as a glass floor but as a trampoline. When the price hits it, it might sink in a little bit, creating those long wicks we discussed in part 4 before bouncing back up. If you draw a thin line, you will get faked out constantly. You should be drawing rectangular boxes on your chart that cover the range of the wicks and the candle bodies where the reversals happened. Let's look at the psychology behind why this works. Why does the price bounce? Imagine the euro to US dollar hits 1.1000 and drops rapidly to 1.0900. There are two groups of people in pain. Group A sold at 1.1000 but closed their trade too early, missing the massive profit. They are thinking, if it ever gets back to 1.1000, I am selling again immediately. Group B bought at 1.1000 and is now trapped in a losing trade. They are praying, please God, let it get back to 1.1000 so I can get out at break even. When the price eventually returns to 1.1000, both groups sell aggressively. This massive influx of sell orders creates resistance, forcing the price down again. Now we introduce the most powerful concept in market structure, polarity, or the break and retest. This is the bread and butter of professional price action traders. Imagine that ceiling in your building. If you smash through the ceiling with a sledgehammer and climb up to the next floor, what does the old ceiling become? It becomes your new floor. Resistance, once broken, becomes support. Here is a step-by-step case study of how to trade this. Imagine the pound sterling to Japanese yen pair has been hitting a ceiling at 150.00 for weeks. It hits it and falls. Hits it and falls. Finally, a massive green candle smashes through 150.00 and closes at 150.50. The amateur sees this breakout and immediately buys at 150.50. This is dangerous. The price is overextended. The professional waits. They wait for the price to pull back or retest the 150.00 level. Now that the price is above it, that 150.00 zone acts as a floor. If the price comes back down to 150.00 and bounces, perhaps forming a hammer candle, which we learned in part 4, that is your entry signal. You are buying the retest of previous resistance turned support. This gives you a much safer entry with a tighter stop loss. We also have psychological levels. These are round numbers. Human beings love round numbers. We don't place orders at 1.1037. We place them at 1.1000 or 1.1050. These big figure levels act as natural magnets for price. If you look at any chart, you will see major reversals often happen exactly at these 00 or 000 numbers. Institutional order blocks are often clustered right around these figures. But the market doesn't just move horizontally, it moves diagonally. This brings us to trend lines and channels. A trend line is a diagonal support or resistance level. In an uptrend, you connect the higher lows. You need at least 2 points to draw a line, but you need a third point to confirm it. This is the rule of 3. Imagine a chart where the price is zigzagging upwards. You take your drawing tool and connect the very bottom of the first low to the bottom of the second low. Extend that line out into the future. When the price touches that line for the third time, that is a high probability buy zone. The market is respecting that diagonal angle. If you copy that line and paste it on top of the higher highs, you create a channel. Trading within a channel is like playing ping pong. You buy at the bottom line, support, and sell at the top line, resistance. However, you must be careful. Trend lines are subjective. You can draw them however you want, which makes them less reliable than horizontal zones. Horizontal support and resistance are objective. The price 1.5000 is the same for everyone. A diagonal line depends on the angle you choose. Therefore, the holy grail of entries is when a diagonal trend line intersects with a horizontal support zone. We call this confluence. Imagine this scenario. You have a horizontal support zone at 1.3000, where the price has bounced historically. You also have a diagonal trend line coming up that intersects exactly at 1.3000. You also see a bullish engulfing candle pattern form right at that intersection. This is a triple confirmation setup. You have horizontal structure, diagonal structure, and candlestick confirmation all pointing to the same outcome. These are the trades that allow you to risk 1% of your account to potentially make 5%. Let's discuss fakeouts or liquidity grabs in more depth, because this is how banks steal your money. The textbooks tell you to put your stop loss just below the support line. The banks know this. They have access to depth of market data. They can see exactly where millions of retail stop losses are sitting, usually 10 or 20 pips below a major zone. Case studies show that frequently, right before a massive move upward, the price will aggressively spike down through the support level, hitting all those stop losses, collecting that liquidity, and then immediately rocketing back up. If you got stopped out there, you were right about the direction, but you were wrong about the entry. This is why we use zones, and why we wait for candle closes. Never trade blindly off a touch. Wait for the candle to close to see if it's a real break or just a wick rejecting the level. If a candle pierces the support but closes back inside the zone with a long wick, that is not a breakout, that is a bear trap. You also need to understand time frame continuity. A support level on a 15-minute chart is like a sheet of plywood. It can hold some weight, but it breaks easily. A support level on a weekly chart is like concrete reinforced with steel. It takes a massive amount of volume to break a weekly level. Always start your analysis on the higher time frames, daily/weekly, to draw your major zones, then drop down to the lower time frames, 1 hour/15 minute, to find your entry. Never trade against a weekly support zone just because you see a small setup on the 5-minute chart. The weekly level will win. The freight train always beats the bicycle. By now, you should have a chart that looks like a battle map. You have your horizontal zones drawn, identifying the key battlegrounds. You have your trend lines tracking the momentum. You know how to read the candles to see who is winning the skirmish. But sometimes price action alone can be deceptive. Sometimes the market looks like it's trending, but internally it's losing momentum. Sometimes a breakout looks real, but the volume isn't there to sustain it. You need a way to look under the hood of the price. You need X-ray vision to see the strength of the engine driving the move. This is where we introduce the mathematical assistance of trading. We are not going to clutter our charts with 100 messy lines, but there are a few specific tools that, when used correctly, act as the ultimate lie detector test for price movement. In the next part, we are going to dive into technical indicators. We will explain why most people use them wrong, lagging behind the market, and how to use them correctly to predict reversals. We will demystify the moving average, the RSI, and the MACD, and show you how to spot divergence, a hidden signal that often predicts a market turn days before it happens. Imagine driving a high-performance sports car down a winding mountain road at night. The windshield represents the price chart. It shows you exactly where you are right now and where the road is curving. But if you only look at the windshield, you might miss critical information about the health of the vehicle. Is the engine overheating? Are you running out of gas? Is the tire pressure dropping? To know these things, you need to look at the dashboard. In trading, technical indicators are your dashboard. They do not drive the car, price action does that. But they provide critical data about the momentum, volume, and volatility of the market that the raw candlesticks might hide. However, we must start with a stern warning. Most beginners treat indicators like magic crystal balls. They plaster their charts with 10 different lines, Bollinger Bands, stochastics, Ichimoku clouds, parabolic SAR, until they can't even see the candles anymore. This is called analysis paralysis. When you have too many indicators, they will inevitably contradict each other. One says buy, the other says sell, and you freeze. Professional traders keep their charts clean. They use indicators not to generate signals, but to confirm them. Let's start with the most widely used tool in financial history, the moving average, MA. At its core, a moving average smooths out price data to create a single flowing line, making it easier to identify the direction of the trend. There are two main types you need to know: the simple moving average, SMA, and the exponential moving average, EMA. The SMA calculates the average price over a set number of periods. The EMA does the same but gives more weight to recent prices, making it react faster to new information. For day trading and swing trading, we prefer the EMA because it reduces lag. We are going to focus on two specific EMAs that act as the backbone of institutional analysis: the 50-period EMA and the 200-period EMA. The 200 EMA is often called the godfather of moving averages. Banks and hedge funds watch this line religiously on the daily chart. It acts as a dynamic line in the sand. If the price is above the 200 EMA, the market is in a long-term uptrend, and you should primarily be looking for buy setups. If the price is below the 200 EMA, the bears are in control. Imagine a scenario where the price of US dollar to Canadian dollar has been falling for 3 months. It suddenly rallies back up and hits the 200 EMA. Historically, this is a massive area of dynamic resistance. You will often see the price touch this line and immediately reject, continuing the downtrend. This is because algorithms are programmed to sell at the average price to get a fair value entry. When the faster 50 EMA crosses above the slower 200 EMA, we call this a golden cross. This is a major long-term buy signal that often precedes months of bullish momentum. Conversely, when the 50 crosses below the 200, it is a death cross, signaling a potential bear market. These are not timing tools for entering a trade this second, but they are crucial for understanding the macro environment. Now let's look at the speedometer, the Relative Strength Index, or RSI. The RSI measures the speed and change of price movements. It oscillates between 0 and 100. The traditional textbook definition tells you that if the RSI goes above 70, the market is overbought and you should sell. If it goes below 30, the market is oversold and you should buy. Here is the trap. In a strong trending market, the RSI can stay overbought for days or even weeks. If you sold the euro to US dollar simply because the RSI hit 70 during a massive uptrend, you would have been steamrolled as the price continued to rocket upwards, keeping the RSI pinned at 80. The RSI is not a reversal signal on its own. It is a momentum gauge. The smart way to use RSI is to look for the failure swing. If the RSI hits 75, drops to 60, and then tries to go back up but fails to break 70 while price makes a new high, the momentum is dying. This leads us to the MACD, the Moving Average Convergence Divergence. This tool is a 2-for-1 special. It follows the trend and measures momentum. It consists of two lines, the MACD line and the signal line, and a histogram, the bars that go up and down. When the MACD line crosses above the signal line, it is a bullish sign. When it crosses below, it is bearish. But the real secret is in the histogram. The histogram measures the distance between the two lines. As the bars on the histogram get larger, the trend is accelerating. As they get smaller, the trend is losing steam. Now we are going to combine these tools to reveal the hidden signal we promised: divergence. Divergence is the most powerful concept in technical indicator analysis because it acts as a lie detector for the price. It occurs when the price action and the indicator disagree with each other. Imagine you are watching a marathon runner. This runner represents the price. They are running up a hill, making new distance records. But you also have a heart rate monitor attached to them. This monitor is the RSI or MACD. As the runner pushes to a new peak, higher high in price, you look at the monitor and see their heart rate is actually dropping, lower high in indicator. This is a contradiction. How can they be running faster if their energy output is dropping? It means they are running on fumes. They are about to collapse. This is bearish divergence. The price makes a higher high, but the RSI makes a lower high. This signals that the buyers are exhausted. The volume supporting the move is drying up. Even though the chart looks bullish, the internal mechanics are weak. Historical trends suggest that a massive reversal is often imminent when this pattern appears on a 4-hour or daily chart. Let's construct a full imagine if trade setup using everything we have learned so far. You are looking at the Australian dollar to US dollar pair. Structure. You see the price approaching a major resistance zone at 0.7500 that you drew from the weekly chart. Candlesticks. As it hits 0.7500, you see a shooting star candle form, showing a long wick rejection. Indicator divergence. You look at your RSI. The price at 0.7500 is higher than the previous peak, but the RSI is significantly lower than it was at the previous peak. You have bearish divergence. Indicator, entry. You wait for the MACD lines to cross downward, confirming the momentum shift. This is no longer a guess. This is a sniper shot. You have structural resistance, candlestick rejection, momentum divergence, and a trend confirmation. You are not hoping, you are executing a statistical edge. You place your stop loss above the wick of the shooting star and target the next support zone. This is how you combine the dashboard with the windshield. However, technical analysis is only 1/3 of the puzzle. You can be the best chart reader in the world, but if a major geopolitical event occurs, like a war breaking out, a central bank changing interest rates, or a surprise election result, your technical patterns will be invalidated instantly. The market will rip through your support zones as if they were made of paper. The charts show you what is happening, but they do not tell you why. To understand the why, you must leave the charts and enter the real world of economics. You need to understand the forces that move money between nations. You need to understand fundamental analysis. Most retail traders ignore this because it seems boring or complex, but ignoring it is why they get blindsided by sudden 100 pip spikes that seem to come out of nowhere. In the next part of this masterclass, we are going to simplify the global economy. We will teach you how to read the economic calendar, how to trade the news without getting killed by volatility, and why a few words from the chairman of the Federal Reserve can move the markets more in 5 minutes than technical analysis can in 5 months. We are going to turn you into a global macro trader. Technical analysis is the study of effects. Fundamental analysis is the study of causes. If technical analysis is the art of reading the waves, fundamental analysis is the science of understanding the wind that generates them. You can be the most gifted chartist in the world, spotting a perfect double bottom pattern on the euro to US dollar. But if the European Central Bank announces a surprise interest rate cut 5 minutes later, that pattern will be obliterated instantly. The price will slice through your support level like a hot knife through butter, and you will be left wondering why the market didn't respect your lines. The market did respect something. It respected the flow of capital based on macroeconomic reality. To survive in Forex, you must understand that currency is, at its core, a share in a country's economy. When you buy the US dollar, you are investing in the United States. You are betting that the US economy is robust, growing, and, most importantly, yielding a return on investment. This brings us to the single most critical driver of currency values: interest rates. Think of interest rates as the yield or the dividend paid out by a country. Imagine you have 2 savings accounts available to you. Bank A, let's call it the United States, offers you an interest rate of 5% per year on your deposit. Bank B, let's call it Japan, offers you an interest rate of 0% or perhaps even negative interest rates. Where is the big money going to flow? It is going to flow into Bank A to capture that 5% yield. In the Forex market, this means investors will sell the Japanese yen and buy the US dollar. This massive flow of capital drives the value of the dollar up and the yen down. This specific dynamic is known as the carry trade, and it is the bedrock of long-term currency trends. But who sets these rates? The central banks. Every major currency has a central bank acting as its architect. In the US, it is the Federal Reserve, or the Federal. In Europe, it is the European Central Bank, ECB. In the UK, it is the Bank of England, BO. These institutions have a dual mandate: to control inflation and to maintain healthy employment figures. Their primary tool to achieve this is raising or lowering interest rates. This is where the economic calendar becomes your Bible. You cannot trade blindly. Every single day, specific data reports are released at scheduled times that give us a report card on a nation's economy. You need to know how to read these reports. The most volatile and impactful of these is inflation data, commonly measured by the CPI, Consumer Price Index. Let's create an imagine if scenario to illustrate the chain reaction. Imagine the US economy is running hot. Everyone is spending money, businesses are hiring, and prices for goods are rising rapidly. Inflation hits 8%. This is dangerous for the economy. The Federal Reserve sees this and decides they need to cool down the economy. How do they do that? They raise interest rates. When rates go up, borrowing money becomes expensive. Mortgages go up, credit card rates go up, and business loans become costly. Spending slows down. Inflation drops. As a trader, if you see a CPI report come out higher than expected, meaning inflation is hotter than the market thought, you can anticipate that the Fed will likely raise interest rates to fight it. Higher rates mean a stronger currency. Therefore, a high CPI number is typically bullish for the domestic currency. Algorithms programmed by Goldman Sachs and JP Morgan read these numbers in milliseconds. If the data deviates from the forecast, they execute billions of dollars in buy orders before you can even blink. This is why you see massive vertical spikes on the chart immediately following a news release. You will often hear the terms hawkish and dovish. These are not just colorful metaphors, they describe the stance of a central banker. A hawk is an official who wants to raise rates to fight inflation. They are aggressive. If the Fed chairman gives a speech and sounds hawkish, the dollar typically rallies. A dove is an official who wants to lower rates or keep them low to stimulate growth and employment. If the Fed sounds dovish, implying they are worried about a recession and want to make money cheap, the dollar typically falls. The Super Bowl of Forex trading occurs on the first Friday of every month at 8:30 a.m. Eastern Standard Time. This is the release of the non-farm payrolls, NFP. This report tells us how many jobs the U.S. economy added or lost in the previous month, excluding the farming industry. It is the purest measure of American economic health. Trading NFP is like trying to jump onto a moving high-speed train. The volatility is extreme. Case studies of NFP releases show that the euro to US dollar can move 50 to 100 pips in a single minute. If the report shows the US added 300,000 jobs when only 150,000 were expected, that is a massive surprise. It implies a booming economy. The dollar will skyrocket. If the number is a disappointment, the dollar crashes. Many beginners try to gamble on this number. They guess high or low 5 minutes before the release. This is often disastrous due to slippage. During the news, liquidity creates gaps. You might have a stop loss at 1.1050, but because price moves so fast, your broker couldn't fill you until 1.1020. You just lost 3 times more than you intended. Professional traders usually wait for 15 to 30 minutes after the release to let the dust settle, and then trade the true direction of the trend. Beyond data, we have geopolitics. Money is cowardly. It hates uncertainty. When there is a war, a pandemic, or political instability, global capital flees from risky assets, like the Australian dollar or emerging market currencies, and runs to safe havens. The primary safe havens are the US dollar, the Japanese yen, the Swiss franc, and gold. Imagine a sudden geopolitical crisis erupts in Europe. Even if the US economy is weak, investors will dump euros and buy US dollars simply for safety. This is known as risk-off sentiment. Conversely, when the world is peaceful and economies are growing, investors feel brave. They sell the safe assets and buy riskier, higher-yielding currencies to make more profit. This is risk-on. You must ask yourself every morning, is the world feeling risky or safe today? Your bias on the chart should align with the global mood. However, relying solely on fundamentals has its own trap. Priced in, the market is a forward-looking machine. It buys the rumor and sells the fact. Imagine experts predict the Fed will raise rates next week. Traders will buy the dollar now, in anticipation. By the time the Fed actually raises the rates next week, the dollar might drop. Why? Because the buyers have already bought. There is nobody left to buy. The news was priced in. This confuses beginners who see good news and watch the price fall. You must understand market expectations versus reality. So you now have the car trading platform, the engine fundamentals, the dashboard, indicators, and the map, technical analysis. You are ready to drive, but you are missing the most important safety feature, the brakes. In trading, your brakes are your risk management. You can drive 200 miles per hour, but if you don't know how to stop, you will eventually crash and burn. There is a mathematical certainty that separates the professional from the amateur, and it has nothing to do with predicting the market. It has to do with how much you lose when you are wrong. In the next part of this masterclass, we are going to dive into the unsexy, but life-saving world of position sizing and risk-to-reward ratios. We will show you a mathematical formula that allows you to lose 60% of your trades and still make a fortune. We will prove to you why win rate is a vanity metric, and why risk of ruin is the only statistic that matters. This next section is the one that saves your bank account. Amateurs focus on how much money they can make. Professionals focus on how much money they can lose. This distinction is the only reason why casinos stay in business while gamblers go bankrupt. In Forex trading, you are not the gambler. You are the casino. You are not looking for luck. You are executing a business plan based on statistical probability. If you do not respect the mathematics of risk, the market will eventually take everything you own. It is not a matter of if, but when. Let's shatter the biggest myth in trading: the win rate. Most beginners believe that to be profitable, they need to win 80% or 90% of their trades. They spend years searching for a holy grail indicator that never loses. Here is the mathematical reality that will liberate you. You can lose the majority of your trades, you can be wrong 60% of the time and still make a fortune. How is this possible? It is possible through the power of the risk-to-reward ratio, RR. The risk-to-reward ratio is simply the amount of capital you are willing to risk in order to achieve a specific profit target. If you risk $100 to make $100, that is a 1-to-1 ratio. If you risk $100 to make $300, that is a 1-to-3 ratio. Let's run a case study comparing two hypothetical traders. Trader A is an ego-driven trader. He needs to be right. He uses a strategy that wins 90% of the time. However, to keep that high win rate, he takes tiny profits and uses massive stop losses to avoid getting stopped out. He risks $900 to make $100. This is a negative risk-to-reward ratio. Over 10 trades, he wins 9 of them. That is $900 in profit. But on the 10th trade, he loses. He loses $900. After 10 trades, his net profit is 0. He wasted his time and stress for nothing. Now, look at Trader B. Trader B is a risk manager. She doesn't care about being right. She cares about being profitable. Her strategy only wins 40% of the time. She loses more often than she wins. However, she strictly targets a 1-to-3 risk-to-reward ratio. She risks $100 to make $300. Over 10 trades, she loses 6 times. That is a total loss of $600. But she wins 4 times. Since each win is $300, her total gain is $1,200. $1,200 gain minus $600 loss equals $600 net profit. Trader B, who was wrong 60% of the time, is the one building wealth. Trader A, who was right 90% of the time, is broke. This proves that win rate is a vanity metric. Risk to reward is the reality. So, how do you implement this? You must adhere to the 1% rule. This is the industry standard for longevity. You should never risk more than 1% to 2% of your total account balance on a single trade. If you have a $10,000 account, your maximum risk on any trade is $100. Not $500. Not $1,000. Just $100. Why such a small number? Because of drawdown. Every trader, including the billionaires, goes through losing streaks. It is a statistical inevitability. If you risk 10% per trade, a losing streak of 5 trades wipes out 50% of your capital. Here is the math of the death spiral that terrifies professionals. If you lose 50% of your account, you do not need a 50% gain to get back to break-even. If you drop from $10,000 to $5,000, you now need to make $5,000 to get back to the start. $5,000 is 100% of your current $5,000 balance. You need to double your money just to recover. If you lose 90% of your account, you need a 900% gain to recover. This is mathematically impossible for most traders. By risking only 1%, a losing streak of 5 trades only puts you down roughly 5%. A 5% loss is easy to recover from. You stay in the game. This brings us to position sizing. This is the technical skill of adjusting your trade size lots to ensure you never risk more than that 1%. Most beginners assume that if they want to risk less, they just trade fewer lots. That is incorrect. Your lot size must change based on the distance of your stop loss. Imagine you are trading the euro to US dollar. You spot a setup. Your technical analysis tells you the stop loss needs to be 20 pips away to be safe. You have a $10,000 account, so your risk limit is $100. You need to calculate what lot size makes 20 pips equal to $100. The formula is risk amount divided by stop loss pips times pip value. In this case, roughly 0.5 standard lots. Now, imagine a different trade on the pound sterling to Japanese yen. This pair is more volatile. Your technical analysis says the stop loss needs to be 50 pips away. You still only want to risk $100. Since your stop loss is wider 50 pips, your position size must be smaller. You would trade roughly 0.2 lots. In both scenarios, whether the stop loss is 20 pips or 50 pips, if you hit your stop, you lose exactly $100. This is the hallmark of a professional. They normalize their risk. They don't look at a chart and say, "I feel lucky, I'll bet big." They calculate the distance to the invalidation point and size their position accordingly. Never open a trade without using a position size calculator. There are free apps and websites that do this. You input your account balance, your risk percentage, 1%, and your stop loss in pips. Tells you exactly how many lots to buy. If you are guessing your lot size, you are gambling. Furthermore, you must understand correlation. This is a hidden risk multiplier. Imagine you see a buy setup on euro to US dollar, a buy setup on pound sterling to US dollar, and a buy setup on Australian dollar to US dollar. They all look great. You decide to risk 1% on each. You think you are diversified. You are not. All three of these pairs are quoted against the US dollar. If the US dollar spikes in value, all three of these pairs will likely drop at the exact same time. You didn't risk 1% on three independent events. You risked 3% on one event, US dollar strength. If you are wrong, you take a triple hit. You must be aware of how your open positions interact with each other. Let's address the concept of break-even. Moving your stop loss to break-even is a powerful psychological tool. Suppose you enter a trade and it moves halfway to your profit target. You are up 1:1. Many professionals will then slide their stop loss from the negative zone to their entry price. Now the trade is risk-free. If the market reverses, you lose nothing, except maybe a small swap fee. This allows you to hold trades longer without fear, hunting for those massive 1:5 or 110 winners that grow accounts exponentially. However, moving to break-even too early is a rookie mistake. If you move your stop too soon, the natural breathing of the market might wick you out before continuing in your direction. You must wait for the market to create a new structural higher low or lower high before trailing your stop behind it. You are locking in profit, protecting your capital, and letting the winner run. Finally, we must discuss the risk of ruin. This is a statistical probability calculation that tells you the likelihood of blowing your entire account based on your win rate, payoff ratio, and risk per trade. If you risk 5% per trade with a 50% win rate and a 1-to-1 reward ratio, your risk of ruin is statistically significant. If you risk 1% per trade with the same stats, your risk of ruin drops to near zero. Your goal is to make it mathematically impossible to blow your account. You now have the mechanical components. You understand the market, the ocean, the analysis, the navigation, and the risk management, the life jacket. But there is one final piece of the puzzle that binds all of this together. You cannot carry all this information in your head. You need a physical document. You need a set of laws that you simply execute, rather than thinking on the fly. In the heat of the moment, when money is on the line, your IQ drops. You become emotional. You need a checklist that prevents you from doing something stupid. You need a trading plan. In the next part of this masterclass, we are going to build your trading plan together, step by step. We will create a daily routine, a pre-flight checklist, and a set of if-then rules that will turn your trading from a chaotic hobby into a boring, predictable, and profitable business operation. If you walked into the cockpit of a commercial airliner, you would see two highly trained pilots. Before they even turn on the engines, they pull out a laminated card, the pre-flight checklist. They do not rely on their memory. They do not rely on their feelings. They go through the list line by line. Flaps set. Check. Fuel levels. Check. Hydraulics. Check. They do this because in a high-stakes environment, human memory is fallible, and human emotion is a liability. If pilots flew based on gut feeling, planes would fall out of the sky. In trading, you are the pilot. Your capital is the plane. The market is the turbulence. If you do not have a written physical trading plan that you read every single day, you are flying blind. A trading plan is not a vague idea in your head like, "I'll buy low and sell high." It is a rigid set of rules, a business contract you sign with yourself, that dictates exactly what you will do in every possible scenario. It removes the need to make impulsive decisions when your heart rate is at 120 beats per minute, because you are watching your money fluctuate. The first section of your plan must define your trader identity. You must pick a lane. Are you a scalper, a day trader, or a swing trader? You cannot be all three. A scalper holds trades for minutes, looking for quick 5 to 10 pip moves. A day trader looks to capture the daily expansion, holding for a few hours and closing everything before the day ends. A swing trader holds for days or weeks, capturing macro moves. Imagine you are a swing trader, but you get bored and decide to take a scalp trade. You are now playing a game you are not equipped for. You will likely apply swing trading stop losses to a scalping environment, which is a mathematical disaster. Your plan must state, I am a day trader. I operate on the 15-minute and 1-hour charts. I do not hold trades overnight. This rule saves you from the overnight swap fees and the risk of waking up to a massive gap against your position. Next, we build your daily routine. This is your pre-game ritual. It should look something like this. Step 1. Wake up and check the economic calendar. Is there a red folder high-impact news event today? If the Federal Reserve Chairman is speaking at 2 p.m., your rule might be, I will not open any new positions between 1 p.m. and 3 p.m. Step 2. Top-down analysis. Open the daily chart. Is the trend up or down? Draw your major support and resistance levels. Step 3. Mental check-in. This sounds soft, but it is critical. Ask yourself, am I angry? Am I tired? Did I fight with my spouse? Am I desperate to make money today to pay a bill? If the answer is yes, the rule is, I do not trade today. The market requires emotional neutrality. Trading while desperate is the fastest way to lose everything. Now we construct the core engine of the plan, the if-then syntax. This is your algorithmic logic. You must write down your setup so clearly that a 12-year-old could execute it for you. It removes ambiguity. For example, if price is above the 200 EMA, trend is up, and price pulls back to a key support zone, and a bullish engulfing candle forms, then I enter a buy position. Notice the capitalized words. If the price is at support but there is no bullish engulfing candle, you do not trade. If there is a candle but it is not at support, you do not trade. You are a sniper, not a machine gunner. You wait for your specific conditions to align perfectly. If they don't, you sit on your hands. Cash is also a position. Equally important is your exit strategy. Most beginners obsess over when to get in, but they have no idea when to get out. Your plan must define your take profit and stop loss before you click the button. I will take profit at the next resistance structure. I will trail my stop loss behind higher lows once I am up 1:1. And the most important rule of all, written in bold red letters, I will never widen my stop loss. Imagine you are in a trade. Goes against you. It is about to hit your stop. You think, I'll just give it a little more room. It's going to turn around. You move your stop down 20 pips. It keeps dropping. You move it again. Suddenly, a small $50 loss becomes a catastrophic $500 loss. Your plan must strictly forbid this behavior. You also need circuit breakers. These are hard stops for your trading session. Just like the stock exchange halts trading if the market crashes too hard, you must halt yourself to prevent revenge trading. Rule: if I lose 2 trades in a row, I am done for the day. Why? Because after 2 losses, your psychology is compromised. You will subconsciously try to make it back by forcing bad trades. You are tilting. Walk away. Live to fight another day. Rule: if I lose 5% of my account in a week, I stop trading for the rest of the week. This creates a safety net that prevents a bad week from becoming a blown account. Finally, your plan must include the feedback loop, the trading journal. You cannot improve what you do not measure. Every single trade you take must be documented. You need to record the date, the pair, the direction, the entry price, the exit price, the result, win/loss, and most importantly, a screenshot of the chart before and after the trade. But don't just record the numbers. Record the feelings. I entered this trade because I was bored. I exited this trade early because I was scared. On the weekend, when the market is closed, you review your journal. You act as your own coach. You will start to see patterns. You might realize, hey, every time I trade the pound sterling to Japanese yen, I lose money. Maybe I should remove that pair from my watch list. Or, I make 80% of my money between 8 a.m. and 10 a.m. Maybe I should stop trading after 10 a.m. This data is gold. It allows you to refine your edge. Let's look at a comparative case study. Trader X wakes up late, grabs his phone, sees gold is going up and buys. He has no target. He risks 5% because he feels good. The price reverses. He panics and sells at the bottom. He gets angry and doubles his bet on the next trade to make it back. He loses again. He has no rules to stop him. By lunch, he has lost 20% of his account. Trader Y wakes up, follows her routine, checks the news and marks her levels. She waits 3 hours for her specific, if-then setup. It never comes. She closes her laptop and does not trade that day. She made $0. Who is the better trader? Trader Y. Because she protected her capital. She followed her business plan. She acted like a professional. Trader X is a gambler who will inevitably go bust. Building this plan is the heavy lifting of your career. It is boring. It is tedious. It requires discipline. But once you have it, trading becomes peaceful. You are no longer guessing. You are simply executing a process. You become a casino manager, spinning the wheel only when the odds are in your favor. However, even with the perfect plan, the perfect strategy, and the perfect risk management, there is one final enemy that can destroy it all. It is the enemy within. It is the voice in your head that tells you to break your rules. It is the fear of missing out. It is the greed that wants more. It is the psychological warfare that the market wages on your mind every second the candles are moving. You can have the best map in the world, but if you panic when the road gets bumpy, you will drive off the cliff. In the final, most crucial part of this masterclass, we are going to dive into trading psychology. We are going to expose the cognitive biases that are hardwired into your brain to make you lose money. We will teach you how to master your emotions, how to think in probabilities, and how to develop the steel mindset required to be in the top 1% of traders who survive this game. This is the final barrier between you and consistency. You have spent the last 9 videos building a Ferrari. You have the engine of fundamental analysis, the chassis of technical analysis, the dashboard of indicators, and the brakes of risk management. But right now, that Ferrari is sitting in the garage. You are about to sit in the driver's seat. And this is where the tragedy usually happens. You can have the fastest car in the world, but if the driver panics at the first sharp turn, closes their eyes when a truck appears, or refuses to hit the brakes because their ego tells them they are invincible, that car is going into a wall. The car is your strategy. The driver is your mind. Trading psychology is not just a soft skill. It is the distinct factor that separates the wealthy from the broke. The human brain is evolutionarily flawed for trading. For millions of years, your brain evolved to keep you alive in the wild. If you saw a threat like a predator, your amygdala, the fear center of the brain, hijacked your nervous system. It pumped you full of adrenaline and screamed, "Run!" or "Fight." This kept your ancestors alive. But in the financial markets, this survival mechanism is your greatest enemy. When you see a red candle dropping against your position, your amygdala perceives it as a physical threat. It triggers the exact same chemical response as seeing a tiger in the bushes. You start to sweat. Your heart rate spikes. You get tunnel vision. Your rational, logical brain, the prefrontal cortex, shuts down. In this state, you are physically incapable of making a logical decision. You will either freeze and watch your account drain, or you will panic sell at the exact bottom. Let's analyze the most common psychological killer: loss aversion. Behavioral economists have proven that the psychological pain of losing $1,000 is exactly twice as intense as the pleasure of gaining $1,000. This imbalance destroys portfolios. Imagine this scenario. You enter a trade. It immediately goes into profit by $200. Your brain floods with dopamine. You feel like a genius. But then you get scared. You think, what if the market turns around and takes this money back? The fear of losing that phantom profit makes you close the trade early. You bank a tiny $200 win. 10 minutes later, the market rockets up, and that trade would have been worth $2,000. You are devastated. Now imagine the opposite. You enter a trade and it drops $200. Your brain refuses to accept the pain. You think, it will come back. I just need to wait. You refuse to close the trade because closing it makes the loss real. You move your stop loss further away to give it breathing room. The market drops another $500. You are now praying, just let me get back to break even. It drops another $1,000. You are paralyzed. Finally, the broker margin calls you and the trade is closed forcibly. You took a teaspoon of profit on the win, and you ate a bucket of loss on the loser. This is how 90% of traders fail. They cut winners short to relieve anxiety, and they let losers run to avoid pain. You must rewire your brain to do the unnatural thing. Accept the risk, stick to the plan, and become numb to the outcome. The solution to this biological flaw is thinking in probabilities. You must stop caring about the outcome of any single trade. One trade means nothing. It is a random event. Professional traders think in blocks of 20 trades. Consider the casino paradigm. A A casino owner does not panic when a gambler wins a jackpot on a slot machine. The owner knows that the machine is programmed with a statistical edge. Over 1 million spins, the casino will win. You are the casino. Your trading strategy is the slot machine. If you lose a trade, it is just a cost of doing business, like a restaurant buying food or paying the electric bill. You do not get angry at the electric bill. You pay it because it allows you to operate. A losing trade is simply the overhead cost of finding the winning trades. Let's look at a case study of a trader named Michael. Michael has a strategy with a 50% win rate and a 1-to-2 risk-to-reward ratio. Mathematically, he is guaranteed to be profitable over time. On Monday, Michael loses 3 trades in a row. He is down 3% of his account. A professional would say, "This is a normal statistical variance," and stop for the day. But Michael is not a professional yet. He takes it personally. He feels the market is targeting him. He gets angry. He wants his money back now. This triggers revenge trading. Michael sees a candle moving fast. He doesn't check his plan. He doesn't wait for a setup. He just buys, quadrupling his position size to make back the 3% loss in one go. The market reverses. He loses 12%. Now he is in a full-blown tilt. He is desperate. He throws everything he has left into a sure-thing trade. It fails. Michael blew his entire account in 4 hours, not because his strategy was bad, but because his psychology was weak. To survive, you must navigate the J-curve of trading proficiency. Stage 1 is unconscious incompetence. You don't know what you don't know. You buy a stock because a friend told you to. You might get lucky, which is the worst thing that can happen because it teaches you false confidence. Stage 2 is conscious incompetence. You realize trading is hard. You start losing money consistently. You devour books, videos, and courses. You clutter your charts with indicators. This is the valley of despair. Most people quit here. Stage 3 is conscious competence. You start making money, but it requires extreme effort. You have to follow your checklist religiously. You are stressed but disciplined. You are fighting your demons every day. Stage 4 is unconscious competence. This is the destination. You look at a chart and you just know. You execute a trade without fear. You take a loss without anger. It becomes as automatic as driving a car home from work. You arrive at the destination without remembering every turn you took. So, what is the final barrier? It is the acceptance of uncertainty. Beginners want to know what the market will do. Professionals know that nobody knows what the market will do. The market is a collection of millions of independent variables. A bank in Japan, a hedge fund in London, a tourist in Paris, and an algorithm in New York are all placing orders for different reasons. It is impossible to predict the future. Once you accept that you cannot predict the future, you stop trying to be right, and you start trying to execute your edge. You realize that you don't need to know what is going to happen next to make money. You just need to know that if this pattern appears, then there is a 60% chance of price going up. You take the bet. You manage the risk. You repeat. This 10-part masterclass has given you the map, the vehicle, and the rules of the road. But I cannot drive the car for you. The journey from this moment forward is a lonely one. It will require you to sit in a room, look at a screen, and fight your own impulses day after day. You will have weeks where you do everything right and still lose money. You will have moments of doubt where you want to quit. But if you persist, if you treat this not as a get-rich-quick scheme but as a lifelong profession, the potential outcomes are unlike anything else in the modern world. You are learning a skill that no one can take away from you. You are learning to generate income solely from your ability to make decisions. You are breaking the link between time worked and money earned. Do not rush to open a live account today. Open a demo account. Practice the technicals we taught you. Feel the emotions of a loss even with fake money. Prove to yourself that you can follow your trading plan for 3 months straight without breaking a single rule. If you can do that, you are ready. The market is the ultimate mirror. It reflects exactly who you are. If you are undisciplined, it will take your money. If you are greedy, it will crush you. But if you are patient, disciplined, and humble, it will reward you beyond your wildest imagination. The theory is done. The execution begins now. Welcome to the 1%. While this concludes our beginner's guide, your education is far from over. In fact, we are just scratching the surface of what is possible with advanced institutional strategies. Many of you have asked to see these concepts applied in real time, in live market conditions, to see exactly how a professional navigates the chaos of the New York Open. We are currently preparing a special live trading series, where we will put real capital on the line using the exact rules we just built. Make sure you are subscribed so you don't miss the notification when we go live.